Guten Tag, hello, I'm sorry I don't speak German at all. So if you want to say things on my back, you can say it in German very easily. Thank you for coming here at the WOT and to this presentation. As we have only 40 minutes, I will try to go a little bit fast for you because you were yesterday, you know why I'm telling that. Because I want you to benefit the maximum you can to this presentation. So in order not to be in a rush at the end, let's start straight, okay? If you have any questions, I will try to take them now, but maybe better after you come to see me at the stand and I will answer all your questions, okay? So that we can leave the room on time. So I'm coming from France to see you. I'm working with traders now in Germany. I'm a trader since almost 20 years now on the markets, and my specialty is to be a technical analysis trader. I think that if you're here, it's that you know about technical analysis or that you want to know a little bit about it. The goal of this presentation is to show you how looking at charts can reveal you some good strategy, trading strategy, or and how to find an entry point, how to put a stop level, and how to read some nice patterns in the trading part. So my career, we don't care about it very much. I told you it's been 20 years I'm working on the markets. It's been since 2011 that I founded my own company, and it's been now 1 year I'm working with Lothar, who is here. Thank you, Lothar. And I'm running the factor portfolio with team traders. It's a free service of recommendations on factors so we can play on leverage. So first, obvious question to the mind of any investor: how do I know which stock, which product, which asset, which underlying asset should I invest in? You have many ways of playing on the markets now. So what shall I do? Shall I go on commodities? Shall I go on stocks? German, European, US stocks? We're going to see that with this kind of approach of the market, you can really find any kind of underlying as soon as it has a good configuration, technical configuration. Okay, one thing that might be obvious, but remember, in a bull market, the only attitude to have is to be long or neutral at worst. In a bear market, the only attitude to have is to be bearish. Why do I say that? Because I have lots of clients or people coming to me and saying, okay, it's going up, it's going up, it's going up. I want to short the top, I want to short the top, and it's the best way to lose money, okay? Better be in the trend, wait maybe for a more clear configuration to say, okay, now maybe we're entering a bear market, but never try this kind of things because it's the best way to lose money. Sell markets that show weaknesses and buy the ones that show the most trend. That might be obvious too, but you will see that it's not always the case. The gaps, you know gaps, when you open on a higher level than the former closing or downside, the gaps often indicate a change of trend, not always, but often, so try to be there at the first day the gap is formed so that you can take the trend in the right, at the right timing. Keep technical analysis simplified, because even in technical analysis, you have many things that you can look at, many indicators, RSI, stochastic, Bollinger, moving average, MACD, everything. You can look at chartism, you can look at Elliott waves, you can look at gain ratio, everything. So the more you keep it simplified, the more it will be efficient. If you look at all the different methodology, you will have 1 point every 10 cents, for example, and it won't be efficient for you. Anyway, the market is always right, okay? You can try to find a magical trick. There are no magical tricks. So the best way to practice this kind of methodology is to put it in front of the market and look with the time, with experience, when the market is right, when you can see the market right, and where is the weakness of the methodology you are using. And once you know this, you know that maybe for looking at one chart, for example, I don't know, let's take a BMW, maybe 80% of the time when you have a divergence on the RSI, it will work. So that means that in the future, you can trust the divergence of RSI on this kind of stock. That's called experience and backtesting. We will see that after. Think like a fundamentalist and trade like a technician. You always have to be aware of the macro average of the context of the market. But to make the best decisions, I will show you how to make it only by looking at the charts. Okay, let's enter the subject now. We have the DAX here. You know about the DAX, everybody? Okay. Okay, so was joking. Okay, the DAX, it's a daily chart here that we have. It's not the DAX nowadays, okay? We will look at more actual graphs after, but I wanted to show you where we have those two bottoms, major bottoms in March 2003 and March 2009. And we are looking now at the RSI, which is an indicator that I use a lot and that is often used by a technical analyzer. And what can we see here? We see that the DAX, during this huge bearish trend, was making a huger bottom here from there to there. Meanwhile, in the same time, your indicator was showing that it was going up from this point, okay? That's what we call a divergence. Now, two things to look at RSI divergence. First, you always have to backtest the underlying you are looking at. For example, that's why I'm showing you the DAX in the past now, to know if in the future you will be able to trust these kind of things. That means look at every divergence you had on the RSI and look if at this moment the DAX shows a reversal on the upside. You can see, and last point is to confirm the divergence. When you see that, that means the divergence is appearing, okay? Because you can't say that every time that the underlying is going one way and the RSI the other way, you won't have any time a divergence. Most of the time, your indicator must be for an upward divergence. It must be in what we call the below the 30 level. That means the indicator will be under, the stock will be underestimate or the underline. And then after, you have to wait that the RSI strongly passed over what we call the neutrality zone at 50, because as it is an oscillator, it's always evolving between 0 and 100. So we call the neutrality zone here at 50. And when you break up the 50, clearly like here, you have what we call a buying signal. That means, that might be strange, but that means that the RSI was giving you a buying signal on the DAX almost here. And believe me, if you were coming to me on March 2003, and I would tell you it's time to buy the DAX here, you would have told me you were crazy, because everybody was not expected that the bottom point here, okay? And once again, after the subprime crisis, you see, the DAX was showing lower level strongly, and during the same time, the RSI was starting to move upward, and then here you have the cross of the neutrality zone. That means that almost here you had a buying signal on the DAX with the RSI, okay? This is very, very efficient. Of course, if I took this example, it's because it's efficient. We will see sometimes that we can't be always good looking at charts, it would be too easy. But that means that can work, and if it can work, and if I know how to see when it is working, that means that everybody can. Not too much because I want to keep my job, but after that, that means that you can look at charts and find some good strategy. And when I say good, that doesn't mean it will work every time. That means it's relevant, and you know how to defend your position to say, I didn't do this like this on coming from nowhere. Now I will show you about less than almost 10 chartist patterns. So as I did it yesterday, I know we have to make it quite fast because I want you to see the charts. Now here is the theory, and after we'll see the charts, and on the charts you will more understand what I'm telling you here with the theory. First,
it was daily chart? Or?
Yes, it was daily charts. Exactly, yes. Sorry, I said it at the beginning. I should have written it, but it's a daily chart. Yes. And this is a good question. Yes, tell me.
What is the best time frame? Yeah.
Okay, so another thing I will tell you, it's not in the presentation. Every time that you're looking at the time frame on a chart, always remember to look also the other time frame upside. If you're looking at the daily chart, remember to look at the weekly, because sometimes maybe there's something you didn't see coming from somewhere else. Maybe you have to zoom or not zoom and everything. And sometimes you can confirm also if you have an indication on the daily chart and maybe another one on the weekly charts. For example, if you look, I don't know, at candlesticks, you might have a candlestick somewhere or anything. Then you can confirm more, even more, your sensation on the chart. Okay, so I look at daily charts most of the time, but it depends on the horizon. If you're making day trading, you won't look at the day charts, you will look at 5-minute charts and everything. But one another thing that's very useful in the technical analysis is that you can look any kind of chart that you want. The only exception is for gaps, offshore, for sure, because the more you take a time frame, a short time frame, the more you will have gaps, because you know that a gap is a measure difference between the past close and the next open. So if you look at a weekly chart, you won't have many gaps, maybe 1, 2 in few years. So first things I want to teach you, it's very, very, very important. That's why I put it in first. It's overlap. Okay, so overlap, this is the definition. Overlap is a horizontal strong level that really cuts the market. What do I mean by cutting? You will see it after, but I can show it to you here. When you draw a horizontal level like this, okay, you have two ways that the markets can play with it. Either it's doing that, so you forget about it, okay? That won't be overlap or anything. But if your market is doing that, anyway, anytime, something like this, and then after it crossed, but it's doing that, okay, that means that here you have an overlap. That means that this level is playing resistance level when the chart is above, and then support level when the chart is upside. Why this is very strong? We're going to see that just after. Channel or range, everybody knows about channel range. It's very easy. Maybe the easiest things to look on a chart, you take two trend lines, parallel trend lines, and one is playing like a support, and the upside one is playing like a resistance, and your course is always moving between those two lines. And we'll see how to play channel, of course. Triangle, so triangle also is very easy because it looks like a triangle when you look at the charts. We'll see one or maybe two. And it's a continuation figure. That's very important. What do I mean by continuation figures? Means that if you succeed to see a triangle on your chart, you have maybe up to 9 times to 10 or 8 times to 10, you will have the same direction of the stocks or the underlying after the triangle, okay? So triangle is a continuation pattern. It means if you enter a triangle in a bullish trend, when you go out of the triangle, you will have a bullish trend, okay? That's very important. Why? Because those kind of things, when you are able to see triangle and real triangles, that means that you always have very, very good ways to find entry points, and I will show you why. Beware, don't look at triangles and think them like wedges, okay? Wedge and triangles are looking quite the same, but they are not the same, okay? So, because wedge is often a reversal pattern when it appears at the end of the movement, okay? That might be a little bit complicated, but you will see it's not that complicated. How to make the difference? First, a triangle is very open, usually, okay? And it's more short in the time. A wedge is very more like this, okay? You can see the difference, triangle, wedge. Wedge is it's taking more time, and it's also, the two trend lines are more close one to the other, okay? When you have a wedge like this, a quite horizontal one, that means that most of the time you're gonna do that, okay? When you have wedges more maybe in an upside direction, you can have that, okay? That's something that's very important. So look at the wedge direction. If the wedge is like this, it's a continuation pattern. If the wedge is more like this, it will be a reversal pattern, okay? And we'll see all that on the charts, and you will get what I'm saying. Historical highs, that might be sometimes interesting. What is a historical high? When a stock is coming to a level that has never been shown before. Why it is more difficult for a technical analyzer? Because when you are on a historical highs, you don't have any retracement, if you look at Fibonacci, for example, because your stock is so high now that you won't have, for example, you're here, historical highs, you won't have anything retracing because your stock is coming from here. But if it's not an historical highs, that means that I have somewhere another point higher than here, and if I have another point higher, that means that anyway I can always take Fibonacci for this kind of distance, and then I have another way of finding targets on the upside, okay? So when you have historical highs, it's more difficult to get targets, but you can do some extensions, and I will show you how. Double top, double bottom, that's a quite easy reversal pattern too. And the name says what it is. In fact, double top, it's when you find a strong level that stops the market, okay? I don't know, let's say 55, for example, first time, and then another time the stock come here, and then it come here also. That's a double top, okay? I will show you how to validate a double top and how to find the target after the double top. The double bottom is, of course, the same. Let's say 32 here. Okay. Everything that you have in technical analysis is symmetrical. When you are looking at an upward movement, you can have always the same on the downside. Okay. Except for historical highs, of course. But okay.
Historical lows.
Yeah, you can. Right. So even now the flag. Flag is like the triangle, same family, continuation pattern. A flag is some small trend lines that are when the price is having a little pause in the trend that it is within it is evolving. I will show you what is a flag and how not to. Okay, for example, your stock is doing that, and then after you have like something like a flag like this, and your stock is going inside the flag, and then it goes up because it's a continuation pattern. So the flag is two parallel trends. They should be inclined in the other way. When you're in an upside movement, the flag should be a little bit downside, and when you're on a downside movement, the flag will be like this, okay? And this is very useful too, because you know it's a continuation pattern. If you succeed to find those kind of flags or triangles, you know that you will have at one time a very good entry point with a good upward potential after, okay? We will see that after too. Head and shoulders. What is a head and shoulders? You know about it? Not at all? Yes, I see technical, okay. When you look at technical analysis, you must know about head and shoulders. So what is a head and shoulder? They named it just because it was easy to understand. You look at, it's three tops. When you look at a head and shoulder, you have three tops like this, okay, almost. And you have here one head and then two shoulders, okay? There are some rules to respect for this kind of pattern. Three major rules. First rule is that you must have quite a relation between head and shoulders that's not too disproportionate. For example, you can't have like a head and shoulder like this, okay? Maybe this is gonna be a reversal pattern. We don't care, but you can't call that head and shoulders because the head is much too high regarding the shoulders. Another thing is that you have the two shoulders should be equal in the potential and in the timing. That means you can have that, for example, and then the stock is doing that, and then you have another shoulder here, okay? It's like a human being, in fact. You have two shoulders here. They must be quite the same, and I don't have one shoulder here and the other one there, for example. So that's the second rule. And the last rule is that the neckline, I heard of the neckline. The neckline is the line where you have here you have the top of the two shoulders, and here you have the neckline with the beginning of the head and everything. The neckline should not be too inclined, okay? That means you can have a neckline like this. You can have a neckline a little bit like this, okay? For example, I can be a bit like this if I didn't, but I won't be like this, I hope for you. Not now, anyway. So that's the three rules of the head and shoulders are the three that I showed you now, and we will see an example just after. Of course, when you have the head and shoulders pattern, on the downside, you can have a reverse head and shoulders, and it's going to be quite the same, but then your stock is going to do that. Okay, it's as if you were reversing the body of the guy and then head and shoulders on the other side. And last thing we're going to see, it's the diamond. Yes, sorry.
What would be a good entry point for the head and shoulders pattern?
Okay.
That's going to be just like you recognize the pattern and then it's over. Like,
yeah, that's very interesting because every time you look at theory, you look at the past of the charts, but we must know that all that I'm telling you now is to be used in the present, okay? So how to, the best entry point would be, if you can, it would be there, but I agree with you. You don't know if you have a head and shoulder before the second shoulder is starting to draw itself, okay? Sometimes you can have a feeling. Sometimes when you have a higher level like this and you see that you're lacking momentum after, that means that the other top is a little bit lower than this one, you can already guess that it might be a reversal. You don't know if it's head and shoulders, but you don't care. What you want to do is win money. It's not to say, I lose my money, but it was a head and shoulder, okay? You say, okay, I don't care, I win money. So the best entry level is here, if you can, but as soon as you see that it might be a head and shoulder, you don't have too much to lose. I mean, even if you sell here, for example, or you take a short position here, and you have a stop around here, here is your risk, and then your target, you report the head here below the neckline, and your target is here. So you see, you have, here is your risk, here's your reward, so that's very good. But the validation of the pattern is when you break down the neckline, and then this is the last signal, okay? If you can enter before, perfect. If you don't, never mind. But some people prefer wait for the validation, even if they won't optimize the entry point, but it's for this kind of question, it's really up to you. If you're aggressive, then you can short before. If you're not too much aggressive and you want to be a little bit less risky, even if you won't have the same reward, so wait that the neckline is broken down. Because maybe you can have another bounce here and then you don't know what it is exactly. Last thing, not last thing, but last chartist pattern today is the diamond. Okay, so what is a diamond? Is once again, as always in technical analysis, it looks like it's called, in fact. So a diamond is something like this, that looks a little bit like diamonds. That's why women understand better this kind of pattern, usually. Okay, so you go upside here, and then after the diamond, you go downside, and then the stock is evolving like this. It might look a little bit like a head and shoulders, because you have a top there, and you might have a top here and a top there, but you don't have any neckline, okay? So it's not really a head and shoulder. It's less often seen on the markets. It's rarer, but it's very useful too. Now that I've showed you all that by text and by my drawing, here's the magical part. That means that really exists, okay? So, yes, we're looking now at the overlap. Do you remember? Okay, this is Airbus, a French company. Not only French, but a major French company. And we don't care about the name, in fact, of the underlying. As soon as we have a chart, we don't care if it's Airbus, if it's Eurodollar, if it's BMW, if it's the Brent, we don't care. But look at those levels that you have in blue here, okay? All those levels are overlaps. So that means that Airbus is very reacting to overlaps. What does it mean? I told you, when you take a horizontal line like this, you see that the stock is evolving upside like if it was a support level, and downside, it's playing like a resistance level. Now look with me at the evolution of the stocks from here, and let's do the move together, okay? So we have a first upward move here, and we find a first resistance that's been tested twice, okay? And then finally this resistance is broken up. As soon as it's broken up, the market will play on this resistance like a support, like you see here, okay? It's very, very efficient and very precise. Next move on the upside is here, and when you break up this level, you see how many times here you act like a support, and then here again, another resistance level, and then you break up through the resistance, and when the market is showing a little pause, consolidation, it comes to this quite same resistance level, and it plays like a support, okay? And here, for example, we are now in November. When I was showing this chart, I was making a presentation in France, and clients came to me and said, okay, I want to short Airbus. Don't you think it's the time to short it? Because you had this gap here, and he thought the stock was lacking momentum. And I told him, beware of this overlap and wait maybe a confirmation. And we were right, because the stock played again on this overlap. And despite the gap, despite the lack of momentum, it goes up again. And you see that once again here, resistance here, supports here. Okay, so that works very much. You have another example on Apple, okay, the major stock of the world now. You see Apple, same thing. Even if you go back years and years before, here you have the resistance level. After you have a major consolidation, but you're not reversing on the downside, and then the upward potential is coming back, and as soon as you break up through this level, you come with a little pullback here on overlap, okay? Here again, you have your resistance here, and when you break up through the resistance, when the stock is having a pause, it's stopped exactly on the resistance level. So every time that you buy on an overlap signal, you're winning, okay? Here you're winning, here you're winning, here again you're winning, here you're winning, here again. So now Apple is starting to get into a consolidation. It breaks down through the trend line here. Now we draw the next overlap, and this is our measured support to survey to know if Apple would be able to enter a bearish trend below this overlap, or if the overlap plays its part, and then Apple will go up.
What is this wedge you're showing?
Yes, this is a wedge, exactly.
What is showing up?
Yeah, so I didn't talk about it because it's maybe, you see, it's maybe a little bit too early to know, because if you draw the trend line a little bit like this or a little bit like that, some people tell me, and they're right, yes, but if you draw it like this, but if the wedge is working, wedge means that you have huge correction potential after. And that's exactly what we call the wedge. It's not a triangle, it's at the end of a movement, and it's a little bit quite horizontal, and you see that inside the wedge, the stock is lacking momentum. Here you have a higher level here, here, and here, and then after you have one here, and then one here. So it's starting to do like this. It's often a reversal signal. That's called a wedge, exactly. Okay, now after we talked about the range, here's one range on American Airlines, okay? You see this range here. Trend line resistance, trend line support, parallel, and then the stock is going from there to there, from there to there, and there again, and then at the end, he lacks of momentum, and it's breaking down his range. And then you have huge downward potential. That is how you can play a wedge. First, how many points do you need to figure that you may be having a wedge? For example, for a trend line, you need 2 points, okay? 2 points make a trend line. For a range, you need, sorry, not a wedge, a range, you need 3 points, okay? You need, for example, here we need 2 top, 1 bottom, and we draw the parallel of the 2 tops with the bottom. And then we might have a channel. After that, you can always try to play the channel, buy at the bottom and sell at the top. And then you buy there. Maybe you won't have sold here, but as soon as you come back here, you would have sold. And here you would have buy, to be very honest. But you would have been wrong. Never mind. I'm not saying that the channel will work for whole life. I'm not saying that you will always be right to play the channel, but 2 things. First, you would have been right at least 3 or 4 times. And when you're wrong, what can you do? As a good trader, what you can do when you try to find those kind of patterns, you do what we call a reverse. That means, okay, you saw quite fast that you were wrong. When you're here, you know that you're wrong because you know the channel is no more working. So you leave your long position and you take a short one. Why you take a short one? Because you know you made lots of technical analysis, and you know that when you have a strong pattern like this, when you reverse the direction of the trend, then you will have a huge potential, okay? That doesn't mean, it's very, very rare to see after a breaking of a channel like this, to see, for example, a move like this, you go there and then after you go back up, okay? It can happen, bad luck, but most of the time you will have that. And as I talked to you about the flag, even if we're going to see another flag, here you have a flag. You have a downside direction, you have a flag, and then after the flag you have also a downside direction. Now how to find a target after a range, you take the distance between the upside and the up trend and the downtrend here, and you report it at the end of the range of the channel when you go out of the channel. So you have a first target around here, okay? And here look how precise that might be. We took the distance before entering the flag here, and you report it at the top of the flag there, and you have exactly your target that were around here by taking the target of the flag. So first target of the range is here, and then after target of the flag is here, okay? Here's a very beautiful range. Why very beautiful? Because we are on the Eurodollar, so everybody knows about the Eurodollar. And we have since 10 years now a huge channel that you see in blue here, okay? Because yesterday some guys told me, I was looking at this one or this one now. Let's look at the big one here, okay? Why it is very, very efficient? Because if you look from there, you will see how the technical analysis, you can't say it doesn't work when you look at this. I remember when the Eurodollar was falling like a knife here from there to there in 2014, okay? I had some clients, some friends, some family in the States, everything said, okay, I want to buy this, I want to go there. Is it the time that I change my dollar to euro? Is it and everybody was waiting when we were in this major falling at the end. Everybody was waiting to the absolute parity, $1 for €1, okay? If you look at the chart, technically, that doesn't mean anything. Maybe it's just a psychological level, okay? But the real support level on the chart was here, on the bottom side of the range, and what happened? The Eurodollar take his support here around 1035 almost, and then it went up. And another time, when it went up here and when the euro was going up against the dollar, everybody told, not everybody, but I was hearing around me, oh, now the Eurodollar is going to 1.4, 1.36 and everything, but the real resistance level was here around 140, 125, 136, and it stopped exactly there, you see, and then it went down. That means that the channel is working, and obviously, if the channel keeps on working, next target will be downside and not upside.
But is this blue line in the middle?
The 112? Yeah. Yes, that's for example, now we draw our technical levels are here. So if we break down the 112, that means we have more confidence on the bearish trend line, and next target will be there. So it's quite more below. It's a middle point, but it was just like a little double bottom that you have here. So we draw it like this. It's between those two levels. Here is the last bottom here. Here's the range, quite the range resistance. When as long as you go in the future, then the level is going down because the range is going down too.
That's a small question.
Yeah.
Back to the
yeah.
picture. And if I take a look at your range now,
yeah.
You can draw two lines so that you can figure out the indicated with the right circle. This is the
here.
Yes.
Yeah.
This is the resistance level.
Yeah.
However, if I take a look at this curve,
yeah.
The last three buttons, A, B, A, C,
yeah. A prime here.
Yeah.
Yeah.
And I can also raise the resistance level.
The support. Those are support levels.
Yes, yes.
The only place where the channel won't work was here, because usually when you test one part of the channel, you have to test the other one. And here we stopped here. It was in fact quite a double bottom here. If you look at this point here.
Yes, but can I consider this double button also as resistance level, so that you can this A and
here.
No, A and C, the button.
Yes, this is the button, but when you talk about button, you talk about support.
Then you can consider this button as a top level, as a resistance that you have.
After you mean yes. If you draw the line like this,
yes.
When you're below this level, it's acting like a resistance. That's what you said.
Yeah.
Yeah, that's what we call an overlap, and maybe it played his act here. But then after, okay. Just to explain to you, and after I have to move on because we don't have many time, but when you have an overlap like this, okay, here is how you look at an overlap, okay? For example, here is today, here is the past. As long as the stock are doing that, is doing that, you can play the overlap. And as soon as it's doing that, okay, then you forget about it. That means that from here, it doesn't work anymore. So it worked here, and then you forget about it. Because yeah, if it doesn't respect it anymore, that means that after, that doesn't mean anything, okay? Yeah, okay. You have 5 minutes, okay. You have that on the DAX on the 10,000 level. At the beginning, the DAX stopped at like a resistance, but when it went up, it doesn't play anymore okay? On the DAX, you have this on the 10,000 here. Before, when it was below, it was doing like this a little bit, and then when it went up and it go back down after, it played like this, so you forget about this level, okay? Okay. Yeah, that's the rule. Okay, now I will go a little bit faster. We have 5 minutes left. Here you find triangles on EDF, okay? EDF in France is like RWE or EON in Germany, okay? You go down here, you have a triangle pattern, and then you go down after. And if you enter another cycle here, you have a downside move, triangle, downside move, triangle, downside move. Here again, downside move, triangle, downside, triangle, okay? I'm sorry, we have 5 minutes, so let's look at this triangle, which is more accurate. This is on Amazon, okay? You have here a huge triangle, very nice one. You can see the triangle, you can see the fifth wave in the triangle, A, B, C, D, E. Usually you said, okay, try to buy at the E wave, okay? Why the E wave, not the C or the A one? Because first of all, when you are at A, you don't know what you are having. You don't know if you're having a flag, a triangle, or anything. Same thing when you are at B and C. After when you're at C, you can start to know if you might have a triangle or anything, but it's always better to wait here to avoid you maybe to be a little bit too stressed, because you know that when you buy here, either you go up the triangle because it's the wave E, either you were wrong, okay? So I have sometimes the question, do I have to enter when I am within the triangle, or do I have to wait the confirmation of the triangle? Here again, it's like you prefer. If you're aggressive like me, you will buy within the triangle. If you prefer to wait a little bit, you can wait for the confirmation. On this example, it's better to be aggressive. Why? Because here it's a gap, okay? I showed you the gap of Amazon after. That means gaps like this means that the upward potential was huge. But here, for example, if you were expecting the confirmation and the stock open here, that means that you lose maybe 10% against me. But maybe also you would have been right, and maybe Amazon would have had bad results, and then it was breaking down, and maybe it was not a triangle, and then you were right to wait, because you won't have lose money, and I would have lose my money, okay? So here it's a very nice example of triangle working on all the way, okay? On the Brent, for example, you have many things. For example, if you look from here, on this upward movement, you have a triangle, continuation pattern. And another thing also very easy to know when you can't have a wedge, it's, for example, you can have open triangle like this. Open triangle is when the triangle is getting more and more high, okay? You won't never have an open wedge, okay? That means that when you have an open pattern like this, it must be a triangle. So upward, triangle, upward. Here you have a little flag. So upward flag, and then you have an upward movement after. And here, at the end of the movement, you have a very nice wedge with the breaking of the wedge here that target a very huge downward potential, okay? Another magical thing here is when you look at all this downside movement on the Brent. I remember some clients telling me where the Brent can stop his drop, and then we were in this kind of a pattern, and for me it was clearly a flag. And when the flag broken down here, I said, okay, the bearish trend is coming back. And everybody was saying, no, it's over. The Brent can't go below $40. We never have seen that and everything. But if you take exactly the movement you have here and you report it as a target here at the end of the flag, you will find maybe $1, around $1 precision, you will have this target, okay? And now that's why we're very strongly bearish on the Brent, because the breakdown through this kind of pattern is for us a very bearish signal. Here on the Nikkei 2, you have the same thing, triangle here. At the difference of Amazon, after the triangle, you won't have an acceleration. You had here what we call a pullback on the former triangle resistance, and then after you have the movement here, okay? So if you were more cautious and you were expecting the end of the triangle here, you would have find the same entry price than if you were in the triangle.
These numbers and
sorry?
ABC.
Yeah, ABC.
Wolf waves.
Yes, small waves, but always.
Wolf wave.
Sorry?
Wolf waves.
It's Elliott waves.
Elliott waves.
Yeah, Elliott waves. Yeah.
Elliott,
Yeah. No, never mind. And here is the wedge. At the end of the movement, you have a wedge, and then here you see, as we saw on the Eurodollar, as we saw on the Brent, the end of a wedge like this is always a huge target on the downside, okay? And here you have what we call a, can anyone name it? Yeah, sorry?
Oh, I have a question.
Yeah, tell me.
How long does the flag have to be? Because when I look at the other charts,
Yeah.
I see several points.
A good question. For me, usually a flag should last around few months, okay? Maybe max 6 months.
On the daily chart.
Yes, on the daily chart, but it depends on which basis you are looking at the chart, in fact. But on a daily chart, maximum 6 months. You can have some flag during, I will show you maybe one if I have time, but I don't think. It's finished? Okay.
Double bottom.
Double bottom here, yes, thank you. And I'm sorry, I didn't have time to show you everything. Here is, for example, a very nice double top on Grenke, okay? When you have a double top like this, what you do is you look at the lower point between the two tops, okay? That's the neckline, and when you break down the neckline here, that means that the double top is validated, okay? So you report the distance between the neckline and the double tops, and you report it at the end of the neckline, and you have your first target here. So you see on Grenke, it was very recently, that works very well, okay? Here you have double bottoms on AXA, okay, just to show you very quickly, but here you have a nice double bottom here also. Downside, double bottom, reverse, upside. Here is a flag, a huge flag, you see. This kind of flag can last maybe more than 6 months because we were looking at long-term distance here, and we have huge potential before the flag, okay? That's the brand, I showed it just before to you. And this is a head and shoulders on the CAC 40, okay? You see here the two shoulders, here the head. The shoulders are quite similar in the amplitude and the timing, and then when you break down, you report first the distance of the head and the shoulders, and then after you can report the distance with the neckline, okay? I'm sorry, I didn't have time to show you all that I wanted to show you, especially this graph on the gold. But anyway, you can come and you can send us any kind of question and anything. We will be there. This is the performance of our portfolio this year with traders. And here is all you need to find to reach the trader team, okay? And I've put you our YouTube channel in France if you want to see some video, if you want to learn French with me, okay? And then you have, so don't hesitate to ask questions, send emails and anything. Thank you very much for coming. Sorry, I have to be a little bit fast.